all. Thank you for joining our online morning lecture session, which is under India International Trade Fair virtual sessions organized by NSE. To brief you all about IITF, which is India International Trade Fair, it is the largest integrated trade fair with B2B and B2C components. It has emerged as the largest consumer goods fair in the Indian subcontinent. The format of IITF has business, social, cultural, and educational dimensions that are waved together where investors and exhibitors, media persons, marketing professionals, and social activists, NGOs, all come together to explore their objectives. Several government organizations use this platform to spread awareness about their programs and policies among the public. NSE, in association with SEBI, is participating in the 40th India International Trade Fair from November 14 to November 27. Due to pandemic condition, the event is planned in online mode and offline mode to reach out larger audience. For online mode, we will be organizing sessions on various topics related to investor awareness from eminent speakers. Two daily sessions branded as opening lecture session and evening lecture session will be conducted uh, where participants joining from various online links like Facebook, YouTube, Cisco WebEx, etc. The session will be of 15 to 20 minutes. With respect to today's morning session, we have Dr. Tirthankar Patnaik, Chief Executive Economist, NSE, on the topic of understanding of macroeconomics. Dr. Tirthankar Patnaik sir is a Chief Economist at the National Stock Exchange of India. He has over 2 decades of experience in the Indian capital markets, academic research, credit research in macro and sector strategy, quantitative finance, and consumer banking. Dr. Patnaik started his career as a researcher at the Indira Gandhi Institute of Development Research and worked on a number of academic and corporate projects in the area of econometrics and quantitative finance, followed by a stint in consumer banking analytics as an analyst with the Global Consumer Group of Citibank in India and Europe. His first focus area was equity strategy for institutional clients, initially with Citigroup Global Markets as India equity strategist, and then with Religare Capital Markets Limited as the India strategist and chief economist. In the last assignment prior to joining NSC, he was a chief strategist and head of research for India at Japan based Mizo Bank. So I welcome you, sir, for the podium. Over to you, sir.
Thanks, Tarun. Good morning, everyone. My take today is on India macro strategy. This is the first of two lectures that I'll be taking as a part of the IITF NSE SEBI initiative. So the first one will be on the macro part of what's happening in the economy, and in the second episode, I will talk about markets. So let me go without much ado into the presentation straight away. So this will be a short presentation. I will go relatively quickly within the charts. It is quite a detailed slide, and should anyone have questions on the slide on the presentation, we'll be happy to share the presentation with you. So what we are essentially saying is the global backdrop is there is a lot of uncertainty, even though we are seeing a significant recovery that is sort of panned out. But the last 3 months have again turned fairly uncertain. And what are these reasons? So the reasons are manifold. One of them is the sharp rise in inflation that has happened across the world, not in India, but across the world. Certain central banks all over the world have turned decidedly less accommodative. There is even talk of raising interest rates. And the other major worry for economies is the lack of vaccine supply. While the rich world has had a meaningful share of its population taken care of by vaccinations, there are large areas. One example would be sub-Saharan Africa, where the vaccinated share of the population is in the 20s. So meaningful differences remain between large parts of the world in terms of vaccines, and these pose a recovery, a hurdle to recovery. These pose a major hurdle to recovery going forward. And as the IMF's World Economic Outlook mentioned in its last October edition, that inflation is becoming the most problematic issue for global central banks. For domestic, economy, I will go in more detail, but the core point is there are many signals of a recovery that's taking place. These recovery signals are telling us that the Indian economy is coming back to stream once the uncertainty regarding COVID and the response measures as a reflection of COVID are going away. So large parts of the economy, particularly contact-based services, are doing rather well now. The question, of course, is how sustainable will this recovery be? And secondly, is this recovery a generic recovery, or is it, just a response to what we saw last year? In other words, is it all the base effect, or do we have a proper recovery in the making? For the central bank, the prioritization remains growth over inflation because it has, chosen to maintain its accommodative stance. So why is that? The MPC, the Monetary Policy Committee of the RBI, said that there is progressive investment in aggregate demand, but this recovery remains uneven. And since the output remains below pre-pandemic levels, the support for policy needs to be continued for now. And the first slide that I said, the uneven nature of global recovery poses further downside risk, and therefore the accommodative stance needs to continue for the economy. Yes. In terms of numbers, last year we saw about negative 7.3% growth. This was the least that we saw in 40 years. So this year, on top of that, we are expecting a 9.2% growth. The RBI's target is about 9.5. We are marginally conservative, and one has to see that even before the pandemic, we were on a sustained downward trajectory in terms of growth. So FY18 was about 6.8%, 6.5 in 19. FY20 we ended up with 4% growth. So meaningful amount of slowdown in the economy leading up to the pandemic, it got exacerbated. So again, my key question of this recovery of 9.2, is it on the base of minus 7.3? Partly and largely yes, but is it also a turnaround after 5 years of downward trajectory? Are we at the trough of a growth cycle? And therefore, if this is true, then we are looking at several years of more sustainable growth going forward. I'll also talk about certain other indicators. Inflation remains a worry. Whole of last year, we ended up with inflation north of 6%. This year, inflation is kind of low. Our numbers are in line with the RBI's. 5.7% was the last time the MPC had a target. They reduced it to 5.3%. I must say here that, in sharp contrast to what's happening across the world, where inflation remains a major problem, the Indian Reserve Bank has actually chosen to reduce its inflation target. So it seems inflation is somewhat under control. But again, the question is, with surging commodity prices and demand recovery, how long can we really go in with this accommodative stance? That remains one of the big imponderables. On exports, we're doing quite okay. I mean, this is again a good recovery. I'll show that in charts later. So, this is the flow of the presentation. On Corona, things are coming off. I will not speak too much about Corona. The charts will basically tell us all. The numbers in India are coming off meaningfully now. Just to, of the many charts that you see here, kindly look at figure 4. So India's doubling time now is about 2000 days. So meaningful amount of drop in the Indian numbers. So to a large extent, the control has been there. And I must say, the vaccination of over a billion, I will not say over a billion people, over a billion vaccinations that we've given so far have been a major factor towards bringing these numbers down. Just a minute. Slide. Okay, cases have stabilized. Last 7 days, our numbers, the average for the last 7 days is about 15,000 cases a day, and now we are sort of seeing numbers come off even further. So, however, that said, you continue to see a lot of resurgence of the pandemic in several countries, Europe in particular. So there is major heterogeneity, as we say, and these things I'll skip now because these are numbers that are largely under control. Jab performance, vaccinations. This is one thing I should sort of pay some attention to. Notice how there is a considerable difference between emerging markets and developed markets in terms of the percentage of population that has been vaccinated. The pace of inoculations in India rose considerably in after July all the way till September, but it seems to have petered out in the near term. The good news is about more than a third of the country, excuse me, has been vaccinated both times. So meaningful amount of support there against the spread. We have seen two weeks after the Diwali festival. So one would have expected, if at all, any kind of a spread in the third wave to have happened around this time, the 2 to 3 weeks into the festive season, where contact-based services at their peak are at their peak. But luckily, we have not seen much. This I will not. I'm no epidemiologist, but I think there is room to say that the disease might have become endemic in India. Again, I have no numbers to say this, other than the fact that the daily numbers seem to be coming off. So these are vaccinations. Again, now let me go back to economics. So global economy, what has happened? I mentioned earlier how the global economy was showing signs of growth, but the growth has become a little uncertain in the last few months. So IMF has actually reduced its growth target for 2021 from 6% to 5.9%. This is a reflection of a resurgence, as I said, in Europe and other places of the virus. There are continued supply disruptions. By now, all of us are well aware of what's happening across container trade globally due to several strategies countries are still following in terms of control on COVID. One of them is China's zero COVID strategy, and this would continue to have some kind of an impact on the global recovery, as the IMF says. And IMF has basically said that these persistent supply disruptions have led to a 40 basis point cut in the GDP growth forecast for advanced economies in 2021 itself. Now, again, in terms of numbers, I just mentioned, so 5.9% for the world, 5.2% for global economy. I'm talking about the second column. Emerging markets are about 6.4%. India stands out. Notice the number of 9.5% is higher than ours. We are 9.2. So RBI, IMF, they're all at about 9.5%. They expect a good amount of recovery in India for this year. Now, I will quickly go through these two slides here. These are sort of a heat map on how large parts of services sector and manufacturing sector in developed economies and emerging markets economies are improving. So if you take the numbers in Feb 20 as a benchmark, so these are PMIs. So any number north of 50 is positive. So you see this red mark around April 2020, and then you see this big recovery happening from March 2021, and now that recovery has sort of petered out. Same thing, slightly more varied in emerging markets in this year. And this is about the recession that I spoke about. I will quickly move through this GDP charts. Yeah. So yes. Now, if you look at what has happened in the economy in the near term, so our GDP in terms of gross value added is showing signs of recovery. I mentioned that part. So we are expecting about 9.2% for this year. Agri has remained stable. Services is showing signs of growth. Industry and overall growth are showing signs of recovery. If I look at Google mobility, I have numbers almost coming back to pre-pandemic levels. So these are Google mobility across 6 major sectors: retail and recreation, grocery and pharma, parks, transit services, which is transport, and then workplaces. So numbers are pretty much at pre-pandemic levels for India. COVID fears do hurt sentiments even now, and business sentiments. So let me just quickly go for here. Now everybody wants to know if this recovery is taking place. I asked myself this question earlier. So what we have done is similar to what we saw earlier. We have basically taken several indicators here. As you can see on the left side of my slide, this is on consumption demand, rural consumption demand, urban consumption demand, and perceptions of consumption demand. So we have normalized these indices. They might mean several things: two-wheeler sales, three-wheeler sales, tractor sales, and what have you. We've normalized that number to 100 for February 2020. And then we've shown how these numbers went down and how we are seeing signs of recovery. So as you can notice, I'll just quickly take an example. Average, rural unemployment was, let's say, 100 in Feb 2020. It went up to 115 and went to 311 in April 20, when we had the nationwide lockdown last year. From 311 to 87, 129, things came back up, and now we are back to 107. So there is significant amount of recovery that has happened in rural employment, as an example here. Several other indicators are showing signs of green. So this is what I meant by saying there is recovery that is seen across several sectors in the economy. That was consumption demand, and this is investment. So the picture is not as clear as one would have seen in investment. There was a significant recovery on a YOY basis. That tells you that it was a lot to do with the base effect. But after that, if you see, the colors are more beige, very little green there to the right side of March. So the short answer from here would be that while there is recovery, this recovery is consumption based and not yet investment based. And this sort of underlines the MPC's commitment to an accommodative stance, because they say that the nature of this recovery remains uneven, and therefore one has to be cautious about moving away from an accommodative stance, about moving away from uh, you or going to an unwinding of the current monetary policy conditions. Yeah, so external conditions are quite nice, as I mentioned earlier. Also, financial markets have shown significant amount of improvement, as we've seen here. So, barring some indicators like debt issuance, which were quite high, I mean, other than that, everything is pretty okay. The 38 that you see in October is it's an anomaly mostly. So, short answer here, I've already summarized this. There are several sectors that are doing quite well, and yeah, I will end my presentation with two slides. This is the long-term chart for India. So while we see growth coming down, we should not lose sight of the big picture. We should see India's growth since 1950, and you will see that these bars that you see here, the horizontal lines, are the decadal growth rates that we saw from 1950 onwards. So it was only after 1980 that India grew above 5% at a decadal, at an average growth over 10 years. That was when we saw some recovery sort of happening in economy and improvement in our economic conditions. Most of my audience here would not belong to that era, but I do. So I can tell this with some confidence, and how life has changed over the last 4 decades, 80s, 90s, 2000s. We will take some time to get back to the 2000s figure, as this chart shows. While there are signs of a good recovery, I will tell you that the question is that, are we seeing a base effect or are we seeing a sustainable recovery? So at this point, I will stop for questions. Thank you very much for your time.
Thank you, sir, for the beautiful insights. I think participant must be gone through it and must be able to understand what are the important parameters that are there into it. We have received multiple questions. So if you allow me, can I ask 3 or 4 questions, as we are
Please.
short of time?
Yes, please.
Okay, sir. So first question is that I am an investor. Is it important for me to understand macroeconomics? If yes, how can I do that?
It's absolutely important to understand macroeconomics. Let me just stop sharing. Maybe without a doubt, it's absolutely important to understand macroeconomics. There are 6 segments that we look at in great detail: the real sector, the external sector, the monetary sector, the fiscal sector. That's 1, 2, 3, 4. Then we see policy, and then the 6th one is politics. So it's real, external, monetary, fiscal, policy, and politics. These are the 6 segments that form the base of any kind of an analysis on markets. For markets, we then add valuations and earnings. So for any kind of an analysis, macro is very important. Now, how to do it? Newspapers these days, information, there's enough and more information. The idea is to pick up the trends to improve your signal to noise ratio, so to speak.
Okay, sir. Thank you. The new question is.
Tarun, sorry to interrupt you. Just one other point. I would
Yes, sir.
heartily recommend the National Stock Exchange's monthly publication called Market Pulse. We have this publication that comes out once a month. In apart from November December, where we bring out a 2 month edition, a big edition. Other than that, it comes once a month, and this one publication will be excellent for investors to get a good idea about macro and financial markets. It's available on the NSE website.
Right, sir. Thank you. One more question is, how internal government and world policies affect economics of Indian market?
So internal government, as I said, the one of the six legs of my macro view: real, external, monetary, fiscal, policy, and politics. Policy is set by the government, and government after government, when they take charge, they look at what's the current policy that has been followed by the existing government, and they modify the policy as they see fit. What we have seen in India over the last several decades is, I mean, I would say several decades, meaning since at least the mid 90s, is that there is broad consensus over the direction of a macroeconomic recovery or the macroeconomic path. It is towards a greater role for markets. It is towards minimum government. How implementation happens there, of course, there are wide differences that we've seen, but otherwise, the broad consensus is towards a more reform architecture. So equity markets are one classic example of such thought. So to answer your question, it definitely is very important as to how policy sets up. That absolutely determines macro understanding and the markets.
Okay, sir. One last question. How soon can the general lending rates of banks can rise?
Like I said, I mean, if you look at inflation from last year, one would absolutely expect the rates would have risen already. But as we saw in the MPC's commentary I mentioned, as we saw in the heat map that I showed, that the current recovery remains quite uneven for now. And this is the thought of the Monetary Policy Committee. They say that while there are several reasons of a good recovery happening in India, we are as yet not really confident if it is indeed a base effect or is it a sustained recovery. And so until that thought is not clear, the RBI's MPC would err on the side of caution and by keeping an accommodative stance. See, if you followed this in slightly greater detail, you will realize that the RBI's GSAP programs, the government securities asset purchase programs, those numbers have started coming down already. So one would probably count that as the beginning of an unwinding stance. Once that happens, the MPC would want to make the operating rate back to the repo rate, not the reverse repo rate. And then once the operating rate does become the repo rate, in other words, systemic liquidity conditions do come down meaningfully, that is when a change or a direction on policy rates will be taken. And of course, bank rates will be reflecting those. So at this point, we expect maybe another quarter, at least at the very least, before bank rates can see any kind of change.
Okay, sir. So this brings to end this session. I thank you all for joining us, and thank you, sir, for giving such an insightful and informative session. I thank you all once again and request all to join us again at 3 with another wonderful session with another speaker. So thank you all.
Thank you. Have a nice time. And I will come up with another session or 4 days from now. Thank you.